Um,
Good morning.
Hope everybody can hear me all right. Been a little bit under the weather, so my voice is not quite there today, but we'll get through everything we can. Just remember, for those of you that have not turned in your midterm yet, it was due Tuesday, okay? So I have most everybody's. Everybody's looks great. Everybody's doing a wonderful job on stuff. So everybody did a very, very nice job on the midterm. Understanding the concepts and using the right forms and everything that was there. So I appreciate that. Okay. And it was open book. I know a few of you asked some questions on it. One thing we'll talk about today, we're going to kind of go through that state refund information that was on there. I know that was something that was a stickler with a lot of people as far as how to handle the previous year's refund. We have a worksheet there, but we'll go through it and we'll kind of show you how that works out, okay? All right, what we're going to start out with today, we're going to go through Chapter 10, talk about adjustments to income. We'll do a problem out of Chapter 10 for Howard and Janet Hamilton, and then we'll open up for some questions there. We're going to change around the syllabus just a little bit. Reason being is I found with my in-class classrooms that with rents and business income, we got 3 chapters basically there that we're going to cover. We're going to divide it up a little bit different. Next week we'll probably do talk about the rent and business, the Schedule E and Schedule C. And then what we'll do is we'll spend the class just on depreciation. Depreciation is a very hard topic for a lot of people to follow. It's even a harder topic to teach because there's so many exceptions to the rules and so many rules that have exceptions. So we'll try to spend just the time doing depreciation only, okay? All right, so we're going to do Chapter 10. First thing I'm going to do is I'm going to talk just a little bit about the handling of the state refund for the that was on the midterm. Okay, so let me just get a problem open here. Okay. All right, so on page 1 of the 1040, when we have a refund from the previous year, okay, and this is a refund, if that person itemizes, if we answer yes to the questions in the box here, and we answer yes there, what will happen is as we jump down to the next field, this will turn red, okay? Our determining factor is we have to take a look at the amount of the refund versus the refundable credits that somebody had from the previous year, okay? If you remember in the problem, we had a refund of $540, and then we had 2 Empire Child credits for $660. Well, since the $660, the amount of the credits, is greater than the refund or the income, we do not have to claim that refund, okay? If it was only 1 child, then we'd take the 540 and we'd subtract the 330 and we'd get that 210 and 210, and we would put that right here in the box, okay? Now, I realize it does say F9 for worksheet, and I know I had a couple people email in that kind of got stuck on that a little bit. That worksheet is outstanding if you have somebody that is a previous year's client and their information is carried forward in our system, or if it's somebody that's bringing a tax return, okay, from the previous year. For us, for the problems, we don't need to worry about the worksheet. That's something that you'll learn to use a little bit more on a regular basis when you're in the office and you have clients that have previous year's information. None of our practice problems or anything that we have here has any of that, so we just kind of have to know the rules. So basically the rule is always going to be, if I have, and I'm going to go to the New York, page 4 here. If I have these credits up here, the Empire Child credits or the Dependent Care credit, those two credits up there, if they're greater than my refund I received, okay, then I do not have to pay tax on the federal on that refund, okay? Another way to think about it, we've talked about it, the refund is income. The credit is like a non-refundable credit. It eats up anything until it's gone. That's what that credit's going to do. Nothing left over to worry about, okay? But if we just have a straight refund with no credit there, then we have to have that as taxable income. The reason we have to know this is New York State no longer sends out the little postcards to everybody that says, here's the refund you need to claim on your federal income tax return, okay? So that's the way that one's handled, all right? Now, the other one too that comes up quite often that I just want to go through regarding state refund is if you paid in the previous year, you paid a state balance due. So let's say that we owed $500 from 2014 to the New York State. Well, what we would do with that is we would go to line 65. We go into our little box here, and there is a line that says Federal State Tax Paid 2015 Estimate State Payments. We're going to click on that. Okay. That brings up, okay, page. Now, typically we'll see this a little bit later when we go through some of our later chapters about estimated taxes and payments and stuff. But down below here is a New York section. Again, you see the estimated payments in the table here, but down below you can see right here where it says New York state or local balance due from previous years, and that could be, you know, any year, paid in 2015, okay? So basically what it's saying there is if we had a balance due in 2000 from our 2014 tax return, which we filed by April 15th of 2015, we could put that in there. So we would put the $500 in there, okay? Now, one thing I want you to note on this from our study of itemized, this goes to the Schedule A. It does not go to the 1040, okay? A lot of times what people will say, well, we put it on that worksheet that is inside that table, and it was on line 65, but if you notice on 65 here, there's nothing there, okay? We have our worksheet over here on the left that says F/S tax paid, so that is there, but that income actually goes to our Schedule A, okay? So you can see right here, income tax paid, our state income tax that we paid for the previous tax year gets added in to our itemized deductions. So that's where that $500 will go, okay? All right. Actually, what we're going to do here, use that problem. This is the way we're going to kind of go through Chapter 10. I found that it's much easier on Chapter 10 for adjustments to income to just look at them right straight on the TaxWise program. The chapter has several good topics, but we're going to take a look at it right on here, okay? So we'll start out with our topics. Okay, so chapter 10 is adjustments to income. The way I want you to think about this, we've done income. We'll have a couple more topics of income that we'll cover with rent and business income, but we've covered our income. We've gotten a adjusted gross income, okay? And then we've taken and we've tried to reduce that by either using the standard or itemized deductions. We've done the exemptions, which that goes all the way back to when we did our filing status and the dependents or qualifying children or relatives on our return. Those would be 4,000. Those would be the exemptions. So we each get 4,000 for each one of those. And then we had our non-refundable credits where we tried to eat up our tax bill. And then if we had anything left over, we had our refundable credits that would pretty much, you know, generate our refund, okay? Prior to us deducting the itemized deductions, we have a section for adjustments to income, okay? In that section are several topics, okay? And you can kind of see them here, and it's all the lines that we're going to talk about, line 23 through 34, okay? Educator expenses, we'll talk about that for our elementary and secondary teachers and how that works. We're not going to talk at all about the certain business expenses with the military. You can read that. I think in the years that I've been doing taxes, if I got a handful of those, that's probably a lot. So we're not even going to worry about that. I want to focus on some other topics this morning. Health savings accounts, we're going to talk about those. They may become a bigger part of our health care with our new administration because they may expand the role of a health savings account to have more people take advantage of them. Moving expenses, we'll talk about, you know, the test to see if you qualify and then what moving expenses that you can deduct. We'll talk briefly about the credit for self-employment tax. Self-employment tax is going to come up more when we get into the chapters on business income from the Schedule C, because we will calculate our self-employment tax based on our net profit, okay? For those that are self-employed, we'll talk about SEP, simples, and qualified plans. What those are, basically retirement plans that somebody is self-employed can take advantage of. And then also self-employment health insurance deduction that we'll talk about. Some of it's covered, like that says there, more in Chapter 6 with our Schedule C, but we'll talk a little bit about it there, okay? We've talked already a little bit, and we'll touch on it, penalty on early withdrawal of savings. We saw that come into play when we discussed in our chapter about the interest income, the 1099 INT. There's a little box there that talks about early withdrawals. Didn't used to see a lot of them, tend to see them now. People are panicking with the interest rates, trying to do different things with their CDs or their savings. Sometimes when they move that money prior to its maturity date, there is a penalty, and we'll see those, and they do get an adjustment to income. We already talked about the alimony income. Well, if somebody declares it as income, that allows somebody to declare it as an expense. We'll talk about IRA deductions. Big one Esther talks about on the radio all the time. When somebody has a tax liability or to hedge their bet against a tax liability, great thing to reduce your tax, and it's also a way to increase your refund and really stretch your retirement dollars. Obviously, a big topic that we'll talk about is student loan interest and deductions. Very, very hot topic during the election, but students these days, the student loan debt in the United States surpassed credit card debt and is now hot on the heels of everybody's mortgage. Mortgage is the greatest debt to Americans, and now student loans is second, surpassing credit cards. So obviously a very, very important topic, and we'll talk about those. And then we'll talk about tuition and fees. This kind of is an expansion of some of the stuff that we talked about in Chapter 16 with the American Opportunity Credit and the Lifetime Learning Credit, okay? So, like I said, the reading's great. You can kind of go through all the different topics you have there, but I found this is a great chapter to teach right on the tax-wise. So we're going to head back there. Okay, so back on the tax-wise here, okay? So remember I said that we're kind of on page 1040, page 1, okay? We've talked about lines 7 through 21. That's our income section, okay? Now we're going to talk about these adjustments to income. All right, what these are is we have our total income from above, and we're trying to lower dollar for dollar our income before we take it over to the section to reduce it by our itemized or standard deductions and calculate the tax, okay? Educator expenses. What these are, it's a $250 allowance per a teacher on the return. So if you have 2 teachers in a joint return, they both are eligible for this. So if we head to line 23, click on our link, we have a little 1040 worksheet 2, student loan education worksheet. We're going to open that, okay? Inside there, okay, we'll come back to student loan interest in a second, okay? But here is an educator expense. Explanation of the box is outstanding. Basically, it's unreimbursed classroom expenses such as books, supplies, computer equipment, related software, things like that, up to $250. If you have a teacher, I have 2 clients. One is a science teacher, does quite a bit with his students, and rather go through the red tape of trying to get things done through his school board, he just pays out of his pocket and gets his specimens for his biology section for dissection. Or if he needs extra chemicals that are on the, not on the Homeland Security watch list, but wants those, that he can get those, and he spends them out of his pocket. So he takes the $250, plus we actually have where he has extra over the $250 that he's not reimbursed for, okay? And then we take that to Schedule A job expenses subject to the 2%. If you remember from when we talked about those, that's where we cover things that the job expenses with union dues and such that was talked about in Chapter 12, okay? If somebody comes in and says they spent less than $250, well, we would only put that amount in. They're not going to get the $250 just because they're a teacher. They have to have expenses, obviously receipted expenses that were not reimbursed, okay? So that's where those would come into play. Another client I have that's a good example, she's the music teacher for a rather small school district that does not have a budget for a musical. She buys the costumes, the scenery, anything that the parents don't chip in, and she takes that out of her pocket. Obviously, to put on a musical for high school is probably more than $250. So when she has those, she can take them to her Schedule A. Sometimes, depending on the how extensive the musical is, we have gotten above the 2% on her, but she knows to bring that all in, and she knows that she has to exceed that 2%, okay? So she knows some years she's going to get it, some years she's not. So it's always a great thing to visit with somebody that has educator expenses, okay? All right. Now, if we go back to our 1040 page 1, we're going to move right down the line here on the adjustments to income. Like I said, we're skipping 24. 25, health savings accounts, okay? You can see there the form 8889, all right? If anybody's familiar with the health savings account, you've probably seen this form already. So we're going to take our link, go into our 8889, all right? All right, so here's our health savings account worksheet, our form 8889. You have to check at the top. It's very important on this one so that it matches the documents that somebody would get from the bank. But make sure you calculate whoever the health savings account's name is in. Also, equally important, make sure you check here, self or family. Is this a health savings account for the self? If it is, then you can see our maximum contribution based on age is smaller. If it's for the family, okay, you can see the contribution is larger, all right? So, always make sure you do that. Equally important is this next line, because this is where people tend to misread or misdo their information for health savings account. This is health savings accounts contributions made for 2015 are those made on your behalf, including those from January 1st through April 18th, 2016 for the 215 year. Do not, I repeat, do not include employer contributions, contributions through a cafeteria plan, or rollovers. What that means is if your health savings account shows up on your W-2 either through a cafeteria plan or as a W code in box 12 of the W-2, then you're having your taxable income already lowered on your W-2. If you put it here plus what comes out of your pay on your W-2, then you're double dipping. A couple years or a year or 6 months, whatever, the IRS will send you a letter that says you are not eligible. You have to prove that you contributed this amount, okay? So what happens if you have a high deductible plan that is $1,300 or $2,600 per family deductible or higher, okay, then you can contribute to a health savings account if that insurance is eligible for it. When you contribute to that, you're basically creating tax-free dollars going in, tax-free dollars coming out, okay? So basically what I'm saying is it lowers your taxable income because it lowers your AGI, and then when you take it out, you just have to show that you used it to pay qualified medical expenses with the exception of insurance premiums. And that's medical, dental, and vision, okay? So make sure on the contributions here on that, okay? All right. If your employer makes contributions for your HSA, it'll show up here, okay? Now, second part of this form talks about the distributions. We have to basically reconcile on our tax return what we spent the dollars on to show that it went to qualified medical. Most all health savings accounts now have a little debit card that you can use for qualified medical expenses, and that card's really set up that you use it at any major retailer, it'll deny the charge or not allow you to use the card if it's not for qualified medical. So it protects you on that. If you have to use it for anything else, you can pay with that, all right? So it has to be qualified medical expenses. As you can see down below, if there's any that you account for in your distributions that were for qualified medical, you pay a 20% tax, okay? Now, one thing I will say, there is an exception here where it says if any of the distributions include on line 16 meet in the exceptions to the additional 20%, check here. If you have a health savings account, that amount rolls over year to year. So if you have money left over in 2015, it would have rolled to 2016. That being said, somebody could actually put money into a health savings account, and then when they stop working, use it when they go and retire and into Medicare. Once you reach that age, that health savings account becomes a hybrid. It becomes either a health savings account, which is tax-free in, tax-free out, or it becomes an IRA that you can take money out that is only subject to tax. You do not have to pay the 20% penalty, okay? I've done this with my mother. We've loaded up her health savings account, hopefully to get her enough money there, tax-free, that will allow her to pay any co-pays or deductibles or anything for her when she retires, okay? So we got over 10,000 in there, and hopefully we'll have enough. If she needed some extra income, she could go into that account and take it out. It would be taxable income, just like a traditional IRA, but she would not have to pay a penalty because she is on Medicare retirement age, okay? All right. All right, next one down. Moving expense. Also a form here. Great little form on this, okay? Okay, as I said, there's a test, okay? So the test is how many miles from your old home to your new workplace, and then the number of miles from your old home to your old workplace. Okay, if you subtract those and it's greater than 50, then you can take moving expenses. If you think about it, somebody lives in Akron on the east side of the city of Buffalo, okay, and they're moving to the west side of Rochester, it might be pretty close, okay? So, you know, it takes pretty good distance, 50 miles, to be able to move to qualify for the moving expenses. Also, you can see in your reading, and I'll let you go through that, that there is a 39-week rule that is in there as far as when it has to be a permanent move. It can't be a temporary move. Okay? All right. Transportation and storage of household goods. If I rent a U-Haul or I hire a moving company, I can write that off when I make my move of greater than 50 miles. Also, if I get to my destination and I haven't closed on my house yet, or it's still under construction, and I need to temporarily store my household goods and personal effects until I can move into my new residence, I can use that. All right. Travel and lodging. Again, only traveling and lodging and moving from your old to your new home. The IRS, as it does everywhere else, has determined that human beings need to eat, so you're not allowed to deduct that, okay? But you can do the travel and lodging. Travel side of it, you can take 23 cents per mile in your move, and you can also do lodging, okay? So if you had to move from, say, Buffalo to Denver, and you could take the 23 cents a mile, and obviously it's a long trip, especially if you're moving with young kids or pets, so there might be a couple stops in there. Okay, you can do that lodging expense too. Now, the one caveat here is if in your trip to move from Buffalo to Denver, you decide to go see Aunt Karen in Memphis, and then you decide to go see Uncle or Aunt Tammy up in Minneapolis, and then you decide to stop back down in Nebraska to see your great-grandmother before you go to Denver, that does not count, okay? We would have to go to Google and make a straight line, all right? Now, the other thing, too, is line 4. Enter the total amount your employer paid for the expenses listed on lines 1 and 2 that is not included in box 1 of your W-2 form. This should be shown in box 12 of form W-2 with code P. So, if my employer, which a lot of companies now, if they relocate you in the company, they will probably pay your moving expenses, okay? So, the one exception, federal government does not do this. I have a lot of Homeland Security guys that move back and forth between Arizona and Texas and Buffalo to guard either border, and the government doesn't like to pay for their moving expenses, okay, but they relocate them. So we get a chance to do this, all right? If they do get any relocation, it's not to cover the entire charges. They always have additional charges. So, again, you can enter that amount, but it's only over what you're reimbursed for, okay? So that's what the moving expense deduction, it's for out of pocket. If your employer is reimbursing you, then you cannot take this, or if they're paying for your move, okay? Next one down, deductible self-employment tax. Just going to touch on this. We won't get into the form because we'll cover that when we get into our self-employment business income chapter. But this is basically just like your employer. On your tax return, when you're self-employed, you will pay Social Security and Medicare on your net profits. Since your employer gets a credit, they figure if you're self-employed, you should get a credit too. So you get a credit for half the tax due on your net profits, or half of the Social Security and Medicare tax that you're paying on your tax return, okay? 28 and 29, we'll talk to those again a little bit later. But basically, SEP, Simples, and other qualified plans, those are self-employment plans that when you're self-employed, you can set up for yourself or your employees. If you have a small business, say a landscape business where it's yourself and 3 or 4 individuals that you provide benefits for, there's credits or adjustments to the income that you can take here for those self-employed. Again, our income would show up above on the Schedule C, however, we can adjust it here. Self-employed health insurance deduction. This is for the self-employed individual, okay? So if I'm a family of 4 and I have a self-employment business for myself, but I buy my insurance for my family, I'm only allowed to deduct what's for me because I'm the self-employed where the income comes from. My children and my wife would end up on Schedule A when the premiums that I pay, okay? So again, if I own the business and I'm the only one involved in the business and my spouse and my children are not, then I do not get to deduct them because they are not part of the self-employment. Okay? Having delay on early withdrawal of savings. Okay? Again, we talked about that with on the 1099 INT. IRA deduction. There's a very good worksheet in here. We'll go take a look. So we're going to go on our link and go to our worksheet. All right, so we have our IRA worksheet here. All right. On this, it talks at the top, are you covered by a retirement plan? Okay. Also talks about some things that are maximum modified AGI for deductible contributions. So based on, are you covered by a retirement plan and your income, this benefit may phase out. Okay. It's a great adjustment to income for those that don't have an employer-based plan and they have some income that is kind of in the moderate range. Okay. On the top, we're dealing with traditional IRAs. Okay. You can see here, you enter based on age. So depending on what our age is, if we're under 50, we can each, if it's a joint return, each person on the return can deduct $5,500. They allow you to do a catch-up if you're over 65, okay? Typically what happens with this, and it's very similar to this and the health savings account, usually for about every $1,000 that goes into these, it reduces your tax or increases your refund by about $150 to $200. So that being said, if I put $4,000 or $5,000 in there, I might only have, if I put $5,500 in there, say, I might only pay, or might really only cost me $4,000 because I'll probably add about $1,500 to my refund, okay? So it's always something good to visit, okay? And that's where it'll do that. Now, if based, and I try to do this, and I'm in an employer-based plan, I can have a penalty for excess contributions. So I have clients that says, no, I want to put that money in there, and I basically have to say it's not a good idea because instead of it helping your refund, it's hurting your pocket because you're having to pay a penalty for excess contributions to retirement accounts, okay? Equally, that is why we reconcile Roth. We know that the Roth is not going to help us on the tax return because this is money that has already been taxed and is going to be coming out tax-free on the other end, but they want us to reconcile it because they want to make sure that we're not making excess contributions, okay? So if you can see, if I put in 4,000 here, okay, it dropped my maximum contribution for the Roth. So I can't try to do both of them, all right? Because if I put in down here in a contribution of another $4,000 in my Roth, oops, okay, you can see that I'm going to end up with some excess contributions because it's not allowing me to go over that 6,500, okay? And that excess contributions is calculated on the form 5329. All right, student loan interest and tuition fees deduction, the last two we're going to talk about here before we do a problem to see these in action. Student loans, if we click on our little worksheet, it's actually going to take us to that worksheet where it showed up where we were doing the educator expenses, okay? So we talked about the educator. Up at the top, you can see that we can put our student loan interest, okay? Now, $2,500, all right, is the maximum. The other thing I want you to pay note to is the phase out, okay? I have a young lady that is a client, a prime example. She has a very good job as a pharmacist. However, that's about 8 to 10 years of school or more. and her husband has a very good job at a manufacturing plant. They both have student loans. Right now, their student loan payments are greater than the mortgage on the house they live in with their daughter, okay? So that's where their student loans are. So obviously they have a lot of interest. However, we can never do anything because married filing joint, their income is in excess of $160,000. So as you can see here, their deduction phases out to zero, okay? So this is one of those phase out categories. So if you have somebody that's gone to grad school or gone on and get their master's or MBA or went to medical school and they land a very good job, chances are they're not going to be able to take advantage of this, or it's going to be phased out starting at a 65 single, $130,000 married. They're going to start losing out on student loan interest, okay? And there's a lot of options right there right now. I will talk to my clients if they have a lot of student loans and they're in deferment or forbearance, or they're even in default, that they need to talk to the school loans, whoever's the administrator for them, and make sure that they have dialogue and figure out a way, because there are a lot of income-based adjustments or forgiveness. But if we do forgiveness, remember, we got to do that as a cancellation of debt. We may show that as income, but there are a lot of options out there right now because of the high volume of student loan debt that would allow somebody to really either cut the life of their student loan or the amount that they owe. And sometimes right after they graduate, if they don't go into their field of study and have the income that is maybe 65 or 80,000 or more, they need to take advantage of this, okay? All right, tuition and fees is down below. However, tuition and fees, one thing is, some things to consider. It almost has you think that if you have an undergraduate student, the education credit, especially the American Opportunity Credit, is a much better choice. Because it says here, in most cases, tuition fees will create a better income tax result by using Form 8863. It knows we have a refundable and non-refundable credit or a lifetime learning credit. However, if you have somebody that's a part-time student and a graduate student, okay, then you may be able to do the tuition and fees, okay? Okay? All right. So we'll talk about this and we'll do a problem that kind of shows you how this can work out. Sometimes it's kind of a perfect storm, but you can see on those, okay? All right. All right, and then the domestic product activities, again, we really don't see any of those. We're not gonna really touch on them. You didn't see the chapter say much about them. The only time I'll see some is I have one client that goes through EG Tax that actually his profession is a whistleblower. There are rewards, percentages of money found that is anything that the government is doing that is wasteful or fraudulent or corrupt. And if you can find those and justify them, there's fees for that, okay? And he has to show that as income, and sometimes the income can be pretty sizable, all right? And then he can deduct his fees for what he spent to research this, and that would be his adjustment to that income, okay? All right, so we're going to do a problem. If you want to turn in your workbooks to chapter, let's see, the workbook, page 117, it's class problem 10-2. It is the Howard and Janet Hamilton, okay? So we'll go ahead and get them started in here. All right. All right, come on. No. Okay. All right. Okay, so we have Howard Hamilton, and his wife, Janet. Okay, and they're living at 765 Johnson Avenue. Okay. All right, we have their date of birth as 5/15/55 for him, and she is 6/12/60. Okay, and he is a principal, and she is a teacher. Okay, they're doing a married filing joint return. They do have one dependent. That would be Scott Hamilton. He was born 2/14/97, and we have his social, and that is their son. That lived with them all year long. Okay, too old for dependent care, but we always check EIC just in case. They lived in New York all year long. Okay. All right, so we have everything there. From our bullet points, it says that they did file a 1040 on page 117, but they were unable to itemize. So we're going to go down to our box and says they did not itemize last year. Okay. All right. And it says that Halford and Jan get a refund. They would like to handle the refund and payment electronically. We didn't worry about the bank. I'll let you take a look at that. But we do have some information sheets on it. Okay. I'm going to put their W-2s in for right now, and then we'll come back to some of these, okay? So I have one for Janet. She's the spouse. We've checked her address to make sure it's accurate on the W-2. We're going to put in she is at United Local School. We have her income and her withholding. Okay. Nothing in box 12, 13, or 14 for her, but we do have her state withholding, so we will put that on there. Okay. So that's her W-2 off page 119. And we're going to go ahead and take care of Howard's W-2 also on page 120. All right, so I'm just going to copy the W-2 with the little tab at the top. And again, this is the taxpayers. Okay. Okay, he's at West Brand Local School. And we have his income. If we notice, though, his income is different in box 3 and 5 than it is in 1. As we look down there, we see that he has a 414H. Well, 414H, if we put that in here, okay, so if we put his income in here, the 37,765, and we put his withholding in, $49.87, we can see that even though we go down to box 14 here and put in the 3,000 that he contributed, it does not change box 3 and 5 like we're used to if there's a D in box 12. So what we need to do is go back up here to the top, and we on 3, 4, 5, and 6 take off the calculations, and you can see it turn 3, 4, 5, and 6 green. So I can put the information directly in there, okay? Because it is now not calculated, make sure that you get it in there exactly as it appears on the W-2. Okay. All right, so we have that. Okay. And then we'll go down below, see that he took part in a retirement plan because he has his 414H, so we check that box in 13. And then we have his state withholding. Okay. All right, so we have their W-2s in there. Okay. Now, what we're going to take a look at is we're going to go through the bullet points. Okay. Well, actually, first thing I'm going to do is the interest. So if I go to the interest on page 119, there's some interest income. I'm going to go into my line 8 where my taxable interest comes in. I'm going to get my Schedule B. And then like we've talked about, everything goes on the B for interest and dividends, but nothing goes directly on the B. Okay? So I'm going to find inside my B, inside the little B box, my interest statement. Okay. And on that, I have something from First National Bank. And we have interest income of $564, but we can see in box 2, we have a penalty for early withdrawal. Well, we can see there's a column over here for early penalties, so we're going to put our 25 in there. That's why it's so important that we use this worksheet and not put things directly on the Schedule B. Okay? So we have that in there. Now, back to our bullet points. Okay? We're going to have some things that are adjustments to income. As you can see already on line 30, our $25 came over. Okay? All right. Howard is a principal at a local high school. He spent $121.22 on supplies for his job as a principal. Well, that's an educator expense. If you're a teacher or principal and you have those out of pocket, we can go to that 1040 worksheet 2. Okay, and under the educator expense, this is for Howard. We're going to put $121.22. Okay. The next line says that Janet is a full-time first grade teacher and spent $321 for supplies in a classroom. Okay. Well, we can put $250 here. That's the maximum. And then as it says here, the remainder has to go to our Schedule A. So we're going to go to our Schedule A on the tree on the left. Okay. We go down to where our job expenses are. And right here in this section, okay, we don't need to use a 2106 because that's more so for somebody that travels or has mileage. In this case, we're going to go to Schedule A line 21 business expense. All right. And on this, we're going to put classroom supplies, and we're going to put the remainder. So we had $321 total, so we have $71 that's going to go in there, okay, because $250 went on the other part of that. All right. Back to the 1040 page 1. Again, we can see the 371 because we have the 250 and the 121, okay, that we have there. All right. Okay. Now, next bullet. Janet would like to contribute $2,000 to a traditional IRA. Well, we're going to go to line 32, our IRA deduction. We're going to take a look here, go to our IRA worksheet. And as it says in the thing, she's doing a traditional IRA, so she's looking for the tax advantage. Okay. So when she gets to that, we can see that under the traditional IRA, we can put in her $2,000. Okay. All right. Okay. That was a huge help for them. They went from owing $215 to having an $85 refund. Okay. So that being said, that $2,000, all right, saved them $300 on their tax refunds. Okay, just on the federal. It didn't include what it saved them on the state. All right. Now, the one last thing that we have that talks about the fact that Janet was enrolled in a part-time graduate program. So, if you look on her tuition statement, okay, we have the Buffalo State Teachers. If you notice down there, she's not a half-time student and she's a graduate student. Well, as the form says, first thing we should do is go take a look at the education credit. So we're going to go to line 68. We're going to get our form 8863, and we're going to see how this does for her as an education credit first. All right. Okay, and again, this is for Janet. Okay. All right, and she's going to Buffalo. Okay, on Main Street. All right, we do have a 1098-T4, the one that's on page 120. We're going to say no for anything from last year. And we're going to put in the EIN number for the school. Okay. All right. Now, we're going to head down to questions. Has the Hope Scholarship Credit or American Opportunity Credit been claimed for the student for any 4 years? Well, if she's in graduate school, chances are she's gone through her undergrad. So we're going to say yes here. And as it says here, once we say yes, it shoots us down to the bottom for the lifetime learning. So we're going to put in the tuition from box 1 of $3,800. Okay. All right. Okay. So that means we've done the education credit for her. Okay. Then have you note that up in your blue box, okay, up in my blue box in the corner here, you can see the federal refund. And sometimes it's a good idea to write this down on a little piece of scratch paper when you're doing this. Federal refund is $845, and the state is $449. Okay, so we'll keep those numbers in mind. All right. Now we're going to see how this does versus the tuition and fees deduction. Okay, so I'm going to go back to my 8863 where I entered the lifetime learning. I'm just going to take that out of there down at the bottom. Okay, so we're going to delete that out. I'm going to go to my 1040 page 1. And down at the bottom, I'm going to go to line 34. And that is actually the same one where we saw student loans and the educator expenses. And I'm going to go in there. Okay. And down at the bottom is our tuition and fees. Okay. So under Janet, I'm going to put $3,800. Okay. All right. So if you look up in the blue box in the corner now, we have 655 and we have 694. Okay. All right. So federal and state. Now, first thing we might look at is 845 is greater than 655. But we have to take a look to the fact that because we lowered our federal adjusted gross income that goes over to the state, increased our state refund. Okay. So that being said, if I take the 845 and I add the 449 together, okay, I get $1,294 between the two. Okay. If I take the 655 and I add the 694 from the second one, okay, I have $1,349. So you can see taking the tuition and fees deduction actually worked out better than the education credit. Okay, so again, kind of a perfect storm. You look at the income, you look at the fact that she was not at least a half-time student, you look at the fact that it's graduate school and what she spent. So time you have only a student on there that is a grad student, this is a great place to visit. Okay, again, has to be a perfect storm because just like the form says here, most of the time, in most cases, the education credits, whether it be the American Opportunity or the Lifetime Learning, is a better deal. But you know, we can see here, and as you see, there's some deduction limitations here too, for 4,000, or it's limited to 2,000 if your income's over there. And then there's a phase out that's a lot more severe than what we see with some of the education credits on the 8863. Okay, so again, has to be kind of a perfect storm. All right. All right, so that's adjustments to income. Okay, any questions from anybody on this? I'm going to open up the mics here, okay? All right, any questions on the adjustments?
I have a question on, this is Cheryl. I have a question on the moving expenses.
Yes.
If you moved, okay, so I moved from New Mexico to New York State.
Mm-hmm.
I was not working in New Mexico. I'm not working yet in New York State. I'm looking for a job, obviously. Can I take moving expenses?
No, you have to move for work.
Does have to be working.
Yep, so, yep. If you read in there, it has to be. So yeah, just moving, you know, from one spot to the other without the intention of employment. And, okay.
Taking care of a family member who was ill is not considered working. I wasn't paid by the state or anything like that.
Yeah. You know, yeah, you'd have a hard time, especially if the IRS came back and wanted to kind of validate that.
Okay.
You know, because you didn't move and become employed. You know, if you moved from New Mexico to Buffalo for a job, for employment, then that would be different, even though you might not have employment right away. But, you know, the fact that you moved just to relocate for the care of the family, you know, you're kind of creating some gray area there.
Well, I couldn't find a job down in New Mexico. That is why I moved back up here to find a job.
Okay. Okay. Yeah.
Gray.
Yeah, it's a tough one because really what they're looking for is somebody relocating because of work or a job or whatever it may be. Okay, that's why they do that old workplace, new workplace test.
Okay, thank you.
All right, any other questions?
Hi, this is Elaine. I have a question.
Yes.
What you just did comparing the lifetime learning credit and the tuition and fees deduction.
Yep.
So you plunked in everything for the lifetime learning and you wrote down, you took a little note on what that was for the amounts.
Mm-hmm.
Then you went in to do the tuition and fees. maybe I missed something there. Did you have to, if you put all of that information in TaxWise, does TaxWise tell you which one's better, or did you have to put the lifetime learning off to the side?
Yeah, you know, it'd be nice if it did it for you and you were allowed to kind of like the married filing, joint married filing separate. There'd be a comparison worksheet. There's not. So you basically have to do the return one way, take the information out, and then do the return the other way and write down the refunds. Yeah.
Okay, did you just do that and I missed it?
Well, I took it out. I left everything. I always first go to the education credit. And I just went down to the bottom where the lifetime learning was and just deleted it. Deleted the 3,800. Okay.
Okay.
And then I went over and did the lifetime, or excuse me, the tuition and fees deduction. Okay.
All right.
You got to be careful because obviously if you leave them both in, then it's a really good deal. Okay. Because you get a double dip. But you just have to make sure on that. I think I've talked before about the what if. And this is a great thing. Let me just kind of show that real quick. I'm just going to mute everybody and I'll be right back here. On a situation like that, if you want to, after you get done with that so that you can go, and you can see that I put this on here, okay? What you can do on the return is if you go up to File, and oddly enough, you go down there and about halfway down, there's a little thing called the what if mode, okay? If I put this return in a what if mode, all right, it basically what I call, you know, baby food vegetable green, because everything that's in baby food is about that color, okay, for vegetables. It turns green around outside. I can now mess this return any way I want to. So I can move that $3,800 wherever I want to, do different things, okay? So even if you see here, if I get rid of this, and I know that this there, and then I can say, well, if we don't take it, your credit's here. Well, if I go back to the what if mode, click on it again, I get this little question. It says exiting the what if mode. Do you want to replace? Well, if I say no, okay, it does a little bit of a calculation. Okay. And then it's adjusting everything back to the original return without messing anything up. Okay. So now I did the calculation. As you can see, I went back to my original without messing up the return with what I did on there. Great for that. Really good for us if you want to show somebody how much they could save by putting money into a traditional IRA. You put it in the what if mode. You say, how much could you afford? You do that. You show them up in the refund monitor how much their refund would increase. Then you go back out of the what if mode and put it back to the original return you did before you discussed that. You know, because if you're doing somebody's return between January 1st and April 15th or the tax deadline, that's the time that they would have to still add to that IRA. So that's always a good thing to do too. Okay. All right. Kind of an expanded answer there, but I hope that made sense for you, Wade.
That was good. Where did you find that what if mode again?
If you go up to File in your top left, you know, right underneath where the blue thing is that says EG Tax 2015, the
Okay.
File menu, the very top left. It's not one of the tiles, but it's just a little word File. And you click on that, and you go about halfway down, and that's the what if mode. Okay. That's where you can use that, and then you look like Warren Buffett or somebody that you're a financial wizard. So.
Can I ask one more question?
Sure.
Regarding the midterm, will you be going over that so we can kind of see what we did right and learn from what we did wrong?
Yep, I'm going to go over it. I'm just waiting for a few more to come in. Some people were not able to get it because their emails or difficulties with the email. So I haven't put anything out there yet. I have looked at everybody. Everybody's done great. Really have. So everybody's done very, very well on it. But I will put, you know, and I'll probably use next Saturday for that, just as far as the problem. That will probably be the problem that I do, okay? So that you can see that one in action. Because really that return for us in offices, but I would guess that's probably 80, 85, maybe even 90% of a typical return that we see. You know, with an itemized deduction, some W-2s, things like that. The only one that would probably be a little bit different that you might see on the final is some retirement income one. But that's really the return that we see. So, okay.
Okay, thank you.
Yep. Any other questions?
Tim, can you hear me?
Yeah, go ahead, Liz.
Maybe you want me to say this for next week, but I had emailed you about that. When you're doing those non-cash charitable contributions, you always have to do that 83. I'm saying 8332, but that's not the right number.
8283.
Yeah, there you go. To input the non-cash, but it doesn't actually necessarily add it to the return, right? It's kind of like the Schedule A or B worksheet.
Well, what that one is for the
I
8283.
couldn't figure out how to override it.
Yeah, you can just put that right into the box. If I go, let me go over back to the return that I was just on, and I'll show you here, okay?
Okay.
Stay right here and open the door for me.
Okay, so on our Schedule A, if we have down here where we have our gifts to charity, okay, we can go into any one of the boxes here. We'll get our little link, and it'll take us to that itemized detailed worksheet, okay? Two things are on that we see all the time. One is, top is the medical, but at the bottom is our contributions to charity, okay? Cash contributions, we're going to put them right here. So if we give to the United Way, we would put that United Way right here, okay? So we have our United Way and say we give, $1 a week, okay? Now, down on the bottom are other than cash contributions. As you can see right after here, it says use Form 8283 if it's more than 500, okay? So if I have goodwill here that I give to, but I only give $475, I can put it right there, okay? I don't have to do the Form 8283. However,
Well, then why are we doing that?
okay, then 8283, all right, say that I gave, there we go, I gave 1,000. I moved out of a house, okay? So I have goodwill, all right, and I might have clothing and household items, okay? And then I have $123, or excuse me, 123 Main Street, okay? And then I can use the, come on. There we go, okay? And then I have that in there. When I go to the bottom, it's looking for information. Well, we cleaned out today, all right? So we took everything out of the house, making room for all of our Black Friday shopping. Don't worry about the date acquired. I'm not going to ask you to, find the receipt of everything. How acquired? You purchased it, okay? Donors basis, well, the way I typically do this because of the 30% rule that they use on there, I'll go in here and say we got $1,000 that we gave, okay? Like I said, we're cleaning out the house, making room for stuff. Well, on this one, I typically take my $1,000 and I divide it by 0.3, okay? That usually is a donor's basis that's pretty accurate for what we're doing here on the 8283. And then at the end, I'm just going to use, if I can spell it, thrift store pricing, because we're using that goodwill or whatever we think the value of it is if somebody sold it there. Then, go back to our Schedule A. Okay, we can see came right over there. All right, so that's the way we put that in there. Okay, does that help answer those, Liz?
Yes, I think I was just making work for myself.
Yeah, like I said, if we're, most of the time,
power went out.
If
okay that day till the power went out, and then I kind of started losing it.
Yeah, unless you got, like I said, unless you're emptying somebody's house from a relative that passed, or mom or dad, or, like I said, you're really purging and moving or whatever it may be, most of the time you're just going to have something that's probably below 500 for clothing. If you get into some household items and you're emptying a house, yeah, you know, you can get over 1,000. You know, make sure you get a receipt from whatever organization, you know, even if it's the AMVET's picking it up. And then, you know, if it's over 500, you know, then we got to itemize it a little bit more. Okay?
Okay, good. Yep, good deal.
All right.
Hey, Tim,
Yes, Monica.
can you, not right now, but can you look and tell me how many homeworks I'm missing
Yeah, I will.
and email it
Just
to
make a
me
note here, okay?
or text it to me? I know I'm behind on a couple.
Okay, that's all right. All right, okay. All right, any other questions? Okay, all right. What I'm going to have you work on this week is I would like you to read chapter, let's see here. Let me take a look at something real quick here. Okay. So I'm going to have you read chapter 9 and chapter 5. Okay? All right. So chapter 9 and chapter 5. What we're going to start talking about next week is I'm just going to kind of go through really some of the income and expenses sections of rentals and business. Okay? And then what we'll do is the following week we'll kind of consolidate and just do depreciation and clergy by itself. Those are two topics that are very, very difficult to teach, but I want to make sure that we understand the other parts of the Schedule E and the Schedule C first. Okay? And then if you guys could do the remaining problems in Chapter 10, that would be great. Okay? We just finish up those other problems. We did 10 too, but the other problems on Chapter 10. Okay? And because some of them have some very good review of some stuff going back from previous chapters too. Okay? All right. Any questions from anybody? Now, one thing I'm going to ask, because I am the eternal optimist, I hope you all realize that, is that, and I will send something out to remind you, but since you guys did all so well, and I know that we're on the home stretch, I need you to email me how you would like your name to appear on your diploma for when you finish class. Okay? So like I said, I am the eternal optimist, and I know that everybody's going to do well even on the final after I saw how well everybody did on the midterms. So email me how you would like your official diploma name to appear. Okay? All right. Okay. So I will see everybody next Saturday at 10, unless I talk to you before that. Like I said, I just have a couple people that have not gotten the computer midterm to me. So if you can make sure you get that turned in, that would be great. Okay? All right. We'll see everybody later.
Goodbye.
Bye.